You check your portfolio Monday morning, up $340. You smile. Feel good. Tuesday afternoon, down $180. You frown. Feel anxious. Wednesday, up $220. Relief. Thursday, down $410. Panic. Should I sell? Friday, up $290. Okay, I'm fine. And by the end of the week, you've forgotten something important. Where are you trying to go? You came into this with a plan. Invest for 20 years. Build wealth. Retire early. But now, you're playing a daily game, up or down, green or red, win or lose. You're checking your account like it's a sports scoreboard, and every time you check, you lose sight of the actual goal. I'm Elizabeth, and I'm going to show you the 5 mistakes that kill compounding before it ever gets a chance to work. These aren't complicated investing errors. You're not buying the wrong stocks or timing the market wrong. These are simpler and way more expensive because these mistakes don't just cost you money, they cost you time. And time is the only thing that makes compounding work. If you want to understand why most beginners never see their money compound and how to actually let it work, hit that subscribe button. Because what I'm about to show you will save you decades of frustration and hundreds of thousands of dollars. Mistake number 1. You're checking your account every day and losing the long-term vision. Let me show you what's actually happening when you check your portfolio daily. You're not just looking at numbers, you're training your brain to care about short-term moves. Monday, up $340, brain releases dopamine. I'm winning. Tuesday, down $180. Brain releases cortisol. I'm losing. Every single day, your brain is being conditioned to react emotionally to normal market noise. And here's the problem. The market is supposed to be volatile. On any given day, the market has a 50-50 chance of being up or down. On any given year, the market has an 80% chance of being up. But when you check every day, you see that 50-50 coin flip, and your brain interprets it as risk. When you check every year, you see the 80% win rate, and your brain interprets it as growth. Here's what the data shows. Investors who check their portfolio daily earn an average of 4.2% per year. Investors who check their portfolio quarterly earn an average of 7.8% per year. Same market. Same investments, just different checking frequency. That's a 3.6% difference in annual returns. Over 30 years on a $100,000 portfolio, daily checker, $341,000. Quarterly checker, $932,000. You just lost $591,000 from opening an app too often. But it's not just about the numbers. It's about what happens to your mindset. When you check daily, you start thinking like a day trader, even though you're not one. You start asking, should I sell now and buy back lower? You start seeing patterns that don't exist. It always drops on Tuesdays. You start making decisions based on emotions instead of strategy. And every decision you make based on a daily move is probably the wrong decision. Here's what actually happens over a year. The S&P 500 might end the year up 12%. But on 140 days out of 252 trading days, it was red. That's 56% green days, 44% red days. If you checked every day, you experienced 140 days of feeling like you're losing, even though you ended the year up 12%. Your brain doesn't remember the yearly number. It remembers the feeling of seeing red 140 times. And eventually, after seeing red enough times, you sell. You sell on a down day because you can't take it anymore, and you lock in a loss that would have recovered if you'd just not looked. Let me tell you about someone I know. March 2020, COVID crash. Market drops 35% in 3 weeks. Person A checks his portfolio every day. Watches it drop from $180,000 to $120,000. Every single day he sees red. Every single day he feels panic. March 20th, he sells everything. I need to stop the bleeding. He locks in a $60,000 loss. Person B checks his portfolio quarterly. Last checked in January. Doesn't look at all during March. Doesn't know about the crash in real time. Checks again in June. Market has recovered. He's actually up from January. He never felt the panic because he never saw the drop. Same market, same crash. One person lost $60,000. The other one didn't. The only difference? How often they looked. Person A is still recovering from that decision. 4 years later, he's rebuilt to $140,000. Person B's portfolio is now worth $310,000 because he never interrupted the compounding. That's the cost of checking too often. You don't just lose money, you lose years of compounding that you can never get back. Here's the solution. Set a schedule. Check once per quarter. Not daily, not weekly, quarterly. Put it on your calendar. January 1st, April 1st, July 1st, October 1st. On those days, you check your portfolio, you rebalance if needed, you make decisions if necessary. The other 361 days of the year, you don't open the app, not because you're ignoring your money, because you're respecting the process. Compounding needs time, and it needs you to not interfere. Every time you check and feel emotional, you're one step closer to making a decision that ruins everything. Mistake number 2, you're pulling money out. Every time it gets big. Now, let me show you the second mistake that kills compounding before it starts. You're building your portfolio. $3,000, then $5,000, then $8,000. You hit $10,000. And something happens in your brain. Holy shit, I have $10,000. That number feels significant. It feels like you've accomplished something. And then the next thought comes. I should reward myself. I've been so disciplined. I deserve something nice. So you withdraw $4,000. Buy something, a vacation, new furniture, doesn't matter what. You're back to $6,000 and you start the process over. $6,000 to $8,000 to $10,000 to withdraw $4,000 to $6,000 to repeat. You do this for years and your portfolio never gets past $10,000. Here's what you're actually doing. Every time you pull money out, you're restarting the compounding clock. Compounding doesn't work on money you spend. It only works on money that stays invested. And the most powerful phase of compounding is the later years, when you have a large base and it's growing exponentially. But you never get to the later years, because you keep celebrating the early years by spending the money. Let me show you the math. Scenario A, you pull money out every time you hit $10,000. After 20 years, you still have around $10,000. You've withdrawn maybe $40,000 total over 20 years. Total value created, $50,000. Scenario B, you never pull money out. After 20 years, you have $118,000. You never withdrew anything. You let it compound. Total value created, $118,000. Same person, same contributions. One keeps pulling money out, one doesn't. The difference is $68,000. But it's actually worse than that, because in Scenario A, you spent $40,000 on things that depreciated or disappeared. In Scenario B, you have $118,000 that will continue growing. Fast forward to year 30. Scenario A, still at $10,000, because you keep resetting. Scenario B, $370,000. You didn't just lose $68,000, you lost $360,000 by celebrating too early. Here's why this happens psychologically. When you hit a milestone number, $10,000, $25,000, $50,000, your brain treats it like you've won. And when you win, you celebrate. You reward yourself. But investing isn't a game where you win and walk away. It's a process where you accumulate and let it grow. Every time you pull money out, you're acting like you won. But the game isn't over. You just hit a checkpoint. Let me tell you about Sarah. She started investing at 26. Aggressive saver, putting away $800 per month. At 28, she hit $20,000. First time she'd ever seen that much money in one account. She thought, I've been so good. I'm going to take $8,000 and go to Europe. I deserve it. She went, had a great time. Came back to $12,000. At 30, she hit $22,000 again. Pulled out $6,000 to buy furniture. At 32, she hit $25,000. Pulled out $10,000 as a down payment for a car. At 35, her portfolio was $18,000. 9 years of investing, $18,000. She did the math one day. If she'd never pulled anything out, she'd have $112,000. She spent $24,000 over the years on things she can't even remember clearly. And she gave up $94,000 in future wealth. Here's the rule you need to follow. Pick a number below which you never withdraw. Ever. For most people, that number should be around $50,000. Below $50,000, the money is untouchable. It's locked. It doesn't exist for spending purposes. Above $50,000, now you can start thinking about whether you want to pull anything out. Why $50,000? Because that's roughly the point where compounding starts doing serious work. $50,000 at 8% returns is generating $4,000 per year. That's real money. That's when your money starts pulling its weight. But if you never let your portfolio get past $10,000 or $20,000, you never reach the point where compounding actually matters. Think of it this way. The first $50,000 is the hardest money you'll ever save. It's all you. Your discipline, your sacrifice, your contributions. But once you hit $50,000, your money starts helping. At $50,000, you contribute $10,000 per year. Your money adds $4,000 equals $14,000 annual growth. At $100,000, you contribute $10,000 per year. Your money adds $8,000 equals $18,000 annual growth. At $200,000, you contribute $10,000 per year. Your money adds $16,000 equals $26,000 annual growth. Eventually, your money is doing more work than you are. But only if you let it get there. Every time you pull money out early, you reset the clock, and you never get to the phase where compounding does the heavy lifting. Mistake number 3, you're not reinvesting your dividends. Now, let me show you mistake number 3. And this one is so simple that it's almost embarrassing how much it costs you. You own stocks or ETFs that pay dividends. Every quarter, dividends hit your account, maybe $50, maybe $200, and you see that cash sitting there. Your brain goes, oh, cool, passive income. This is what everyone talks about. And you leave it in cash. Or worse, you spend it. It's only $200. I'll just use it for groceries this month. Here's what's happening. Dividends are not extra money that appeared out of nowhere. When a company pays a dividend, the stock price drops by exactly that amount. You owned $10,000 of stock. It pays a 3% dividend. You get $300 in cash. Your stock is now worth $9,700. Your total value is still $10,000. It's just split between $9,700 in stock and $300 in cash. If you spend the cash, you're left with $9,700. If you reinvest the cash, you buy more shares and you're back to $10,000 invested. This seems small, $300 here and there. Who cares? Let me show you who cares. Portfolio, $100,000 in dividend-paying index fund. Dividend yield, 2%. Time horizon, 30 years. Scenario A. You take the dividends as cash and spend them. After 30 years, your $100,000 grows to $180,000 from price appreciation. You also received $60,000 in dividends over 30 years, which you spent. Total value, $240,000 total benefit. Scenario B. You reinvest the dividends automatically. After 30 years, your portfolio is worth $324,000. Same starting amount, same investments, you just clicked one button. Reinvest dividends automatically. Difference, $84,000. But it's actually worse than that, because the $60,000 you spent in Scenario A, you probably don't even remember what you spent it on. $2,000 per year spread across groceries, random purchases, small upgrades. It disappeared into your lifestyle, and you have nothing to show for it. Meanwhile, in Scenario B, you have $324,000, and it's still compounding. 10 years later. Scenario A, $240,000. Scenario B, $520,000. That one checkbox, reinvest dividends, is worth $280,000 over 40 years. Here's why people don't do this. They think dividends are income. And income is meant to be spent. That's what income is for. But dividends during your accumulation phase are not income. They're compounding fuel. You're not retired. You're not living off your investments. You're still building. Every dividend you take as cash is money that stops compounding. Let me show you what this looks like in practice. You have $50,000 in VOO S&P 500 ETF. It pays about 1.5% in dividends annually. That's $750 per year, about $187.50 per quarter. Every quarter, $187.50 hits your account. If you take it as cash, you get $187.50 to spend. If you reinvest it, you buy 0.42 more shares of VOO at $450 per share. Next quarter, you now own 0.42 more shares. Those shares also generate dividends. You get $188.28 instead of $187.50. The quarter after that, $189.07. It's tiny. Barely noticeable. But over 20 years, those tiny increases compound into thousands of extra shares. Here's the solution. Go into your brokerage account right now. Find the setting for dividend reinvestment. Turn it on. That's it. That's the entire fix. Most brokerages call it DRIP, Dividend Reinvestment Plan. You click one button. From now on, every dividend automatically buys more shares. You never see the cash. You never have the option to spend it. It just quietly compounds in the background. And here's the thing. This is the easiest fix of all 5 mistakes. You don't need discipline. You don't need to change your behavior. You just need to click one button, one time. And over your lifetime, that one click is worth 6 figures. Mistake number 4. You're waiting for a dip and missing the entire bull run. Now let me show you mistake number 4. And this one drives me crazy because I see it constantly. You have money ready to invest. Let's say $10,000. You're excited. You're ready to start building wealth. But then you think, wait, what if the market crashes next week? I should wait for a better entry point. So you wait. A month goes by. Market is up 3%. You think, see, good thing I waited. It's too high now. I'll wait for it to drop. Another month, market is up another 4%. Definitely overvalued now. It has to correct soon. 6 months later, market is up 15%. You're still waiting. A year later, market is up 22%. You're still in cash, still waiting for the dip. Here's what just happened. You tried to time the market. And while you were waiting for the perfect entry point, you missed a 22% gain. Your $10,000 could be $12,200 right now. Instead, it's still $10,000. You didn't lose money, but you lost opportunity. And in investing, lost opportunity is the same as lost money. Let me show you the math on this. Person A. Invest $10,000 immediately on January 1st, 2020. Market drops 35% in March. COVID. Portfolio is worth $6,500. Doesn't panic, doesn't sell, just holds. By December 2020, market recovers. Portfolio, $11,800. By December 2021, market continues up. Portfolio, $15,200. By December 2024, portfolio, $18,900. Person B waits for the right time to invest $10,000. January 2020. Market is too high, I'll wait. March 2020. It's crashing. I should wait for it to bottom out. April 2020. It's recovering too fast. I missed the bottom. I'll wait for the next dip. December 2020. It's back to all-time highs. Definitely overvalued now. 2021 to 2024. Continues waiting. December 2024. Still has $10,000 in cash. Person A gained $8,900. Person B gained $0. Person B was smart. He was careful. He was trying to avoid losses. Person A was dumb. He just invested immediately without thinking about timing. Person A is $8,900 richer. Here's what's actually happening when you wait for a dip. You're trying to outsmart the market. You think, I'll wait until it drops, then I'll buy low. But here's the problem. You don't know when it will drop, and when it does drop, you'll be too scared to buy. Let me prove it. March 2020. Market crashes 35%. If you were waiting for a dip, this was your moment. This was the opportunity. Did you buy? Most people didn't. Because when the market is actually crashing, it feels like it's going to zero. You're not thinking, what a great buying opportunity. You're thinking, oh shit, the world is ending, so you don't buy. You wait for it to stabilize. By the time it stabilizes, it's already recovered 40%, and you missed it. Here's the data that proves this. From 1950 to 2024, if you invested in the S&P 500 on the worst possible day each year, the day before the biggest crash, your average return would be 9.8% annually. Now, if you invested on the best possible day each year, right at the bottom, your return would be 10.4% annually. The difference between perfect timing and terrible timing is 0.6%. Over 30 years on $100,000. Worst timing, $1,640,000. Perfect timing, $1,810,000. The difference is $170,000. But you know what the difference is between trying to time it and missing the market entirely? Trying to time it and staying in cash, $100,000. You lose $1,540,000 by waiting. Here's the framework you need to understand. Time in the market beats timing the market. It's not about when you get in. It's about how long you stay in. The people who build wealth aren't the people who perfectly timed the bottom. They're the people who invested early and never left. Let me tell you about two people I know. Person A started investing in 2015, contributed $500 per month every month, regardless of what the market was doing. 2015, market up, kept investing. 2016, market flat, kept investing. 2018, market down 6%, kept investing. 2020, market crashed. Kept investing. 2022, market down 18%, kept investing. Today, his portfolio is worth $87,000. Person B has been waiting for the right time since 2015. 2015, too high. 2016, sideways market, I'll wait. 2018, see, it dropped. Good thing I waited. I'll buy after it drops more. 2020, it crashed, but it might drop more. I'll wait. 2022, another drop, definitely going lower. Today, he has $54,000 in a savings account, earning 0.5%. Person A invested $54,000 total over 9 years, and now has $87,000. Person B saved $54,000 and still has $54,000. Person A is $33,000 richer from not trying to time the market. Here's the solution. Stop waiting. Invest today. Not next week. Not after the next dip. Today. If you have money ready to invest, invest it now. And then set up automatic monthly contributions so you never have to make the timing decision again. Every paycheck, $500 automatically goes to your brokerage and buys index funds. You don't think about it. You don't time it. It just happens. This is called dollar cost averaging, and it removes the emotional decision entirely. Some months you'll buy high, some months you'll buy low. Over 20 years it averages out, and you'll have compounded wealth. The person still waiting for the dip will still be waiting. Mistake number 5. You're over-diversifying into 47 different things. Now let me show you the 5th mistake. And this one sounds counterintuitive because you've been told your whole life to diversify. Don't put all your eggs in one basket. Spread your risk. Diversification is key. And that's true to a point, but most beginners take it too far. You open your brokerage account and you see 12 individual stocks, 8 different ETFs, 3 bond funds, 2 international funds, 5 sector-specific funds, 4 dividend stocks, some crypto, a REIT or 2. You own 47 different things, and you think, I'm diversified, I'm safe. But here's what you actually are. Over-diversified. And over-diversification is just as bad as no diversification. Here's why. When you own 47 different investments, you've basically recreated the entire market. But in a worse way, because you're paying fees on 47 different things. You're tracking 47 different things, you're rebalancing 47 different things, and your returns, they're going to be almost identical to just owning one broad index fund. Except your returns will probably be slightly worse because of all the extra fees and your inability to actually manage 47 positions effectively. Let me show you the data. Portfolio A, 47 different stocks, ETFs, funds, etc. Average annual return over 10 years, 5.9%. Portfolio B, 3 index funds, total U.S. stock, total international, total bond. Average annual return over 10 years, 8.3%. Difference, 2.4% per year. on $100,000 over 30 years. Portfolio A, $500,000. Portfolio B, $1,006,000. You just lost $506,000 by being too diversified. Here's what's actually happening. You're confusing diversification with safety. You think, if I own 47 things, I can't lose. But diversification doesn't protect you from market crashes. It protects you from individual company risk. If you own one stock and that company goes bankrupt, you lose everything. If you own 500 stocks, like in an S&P 500 index fund, one company going bankrupt doesn't matter. But owning 47 random individual positions doesn't give you much more protection than owning 3 broad index funds. And it makes your life way more complicated. Let me tell you about Josh. He started investing in 2018, watched a bunch of YouTube videos, got excited. He bought Apple, Microsoft, Tesla, Amazon, Google, tech stocks, VOO, VTI, QQ, index funds that overlap, SCHD, VYM, Dividend ETFs, VNQ Real Estate, BND Bonds, VXUS, International, a few individual stocks his friends recommended. He had 23 positions. Every quarter, he spent hours rebalancing, moving money from one fund to another, trying to optimize. After 5 years, his average annual return, 6.1%. His friend Alex started investing the same year, bought 3 funds, 70% VTY, total U.S. stock market, 20% VXUS, total international, 10% BND, total bond market. Set it, forgot it, rebalanced once per year. After 5 years, Alex's average annual return, 8.5%. Same market, same time frame. Alex made 40% more money by owning less stuff. Here's the rule. For most people, you need exactly 3 funds. Total U.S. stock market, VTI, VTSAX. Total international stock market, VXUS, VTIAX. Total bond market, BND, VBTLX. That's it. Allocation depends on your age and risk tolerance. Young, 20s to 30s, 80% U.S., 15% international, 5% bonds. Middle, 40s to 50s, 60% U.S., 20% international, 20% bonds. Older, 60s plus, 40% U.S., 20% international, 40% bonds. 3 funds. Automatic contributions. Rebalance once per year. You will outperform 90% of people trying to be clever with 47 different positions. Here's why this works. Those 3 funds give you exposure to over 3,500 U.S. companies, over 7,000 international companies, thousands of bonds. You own a piece of the entire global economy. You're diversified across every sector, every company size, every geography. And you did it with 3 funds. No complexity, no tracking 47 positions, no hours spent rebalancing, just simple, effective diversification. Here's what happens when you over-diversify. You can't track everything. You think you're paying attention, but you're not. Some positions are underperforming and you don't notice for months. You pay more in fees? Every fund has an expense ratio. When you own 47 things, those fees add up. You tinker constantly. You see one fund doing well, so you move money into it. That fund then underperforms. You chase performance and lose money. You create tax problems. Every time you rebalance or move money, you trigger taxable events. More positions equals more taxes. You dilute your returns. Some of your 47 positions are mediocre. They drag down the good ones. You end up with average returns despite owning everything. Let me give you a mental model. Owning 47 different investments is like trying to eat at every restaurant in your city. You think, I'll try everything. I'll find the best dishes. But what actually happens? You spread yourself thin. You can't remember what you ate where. Nothing stands out. It all blends together into mediocrity. Meanwhile, someone else finds 3 great restaurants, eats there regularly, knows the menu, gets consistent quality. Who has a better experience? Here's the solution. Simplify. Reduce your holdings to 3 to 5 core positions. If you currently own 47 things, here's what you do. Sell everything, yes, all of it. Pay the taxes if you're in a taxable account. It's worth it. Buy 3 index funds, VTI, VXUS, BND. Set your allocation based on your age. Set up automatic contributions. Check once per quarter, rebalance once per year. That's it. Your returns will improve, your stress will decrease, your taxes will be simpler, and you'll finally let compounding actually work instead of constantly interrupting it with optimization. Conclusion: let me bring this all together. These 5 mistakes cost you more than money. They cost you time, and time is the one thing compounding actually needs. Mistake number 1. Checking daily leads to: you lose $591,000 from emotional decisions. Mistake number 2. Pulling money out arrow. You lose $360,000 by never reaching critical mass. Mistake number 3. Not reinvesting dividends arrow. You lose $280,000 from one unchecked box. Mistake number 4. Waiting for the dip. You lose $1,540,000 from staying in cash. Mistake number 5. Over-diversifying. You lose $506,000 from complexity. Total cost of these mistakes: $3,277,000 over a lifetime. That's not an exaggeration. That's the actual math when you compound these errors over 40 years. Here's the good news. Every single one of these mistakes is fixable. Today, you can stop checking your account daily, set a quarterly reminder, and delete the app from your phone. You can decide right now that you won't pull money out until you hit $50,000 minimum. You can turn on dividend reinvestment in your brokerage settings. Takes 30 seconds. You can invest the cash you've been sitting on. Today, not next week, you can simplify your portfolio to 3 funds. Sell the other 44 things. These aren't complicated fixes, they're simple decisions. But here's the thing most people miss. These mistakes aren't about intelligence, they're about behavior. Smart people make all 5 of these mistakes constantly because these mistakes feel right in the moment. Checking daily feels like staying informed. Pulling money out feels like rewarding yourself. Not reinvesting dividends feels like taking profits. Waiting for a dip feels like being smart. Over-diversifying feels like being safe. But feelings don't compound. Money compounds. And money only compounds when you stop interfering with it. Let me leave you with this. Compounding is the most powerful force in wealth building, but it's also the most fragile. Every time you check your account and make an emotional decision, you break it. Every time you pull money out to celebrate, you break it. Every time you see a dividend and spend it, you break it. Every time you wait for perfect timing, you break it. Every time you complicate your portfolio, you break it. Compounding needs one thing from you: to be left alone. Contribute consistently. Reinvest automatically. Don't look, don't touch, don't tinker. Do that for 20 years and you'll be wealthier than 95% of people who are smarter than you. Because wealth isn't built by the smartest people. It's built by the people who get out of their own way. Fix these 5 mistakes. And let compounding do what it does best: make you rich while you're not paying attention.